By now, I'm sure all of you know that mortgage rates have hit 5%. Going into the year, we all knew rates were scheduled to go up 1%. Now, what we didn't count on was that rates would go up a full percent in just a matter of like 3 months. Now, while we all know that increasing rates tend to cool the market off, today I'm going to explain to you how and why this affects buyers, and then explain how this can potentially be circumvented and manipulated by lenders. Now, the reality is this: the feds have to stop this absurd inflation. In speaking with financial gurus much wiser than myself, the general consensus is this: most likely rates will continue to climb for another 3 to 6 months, again, attempting to squash this hyperinflation. Now, once inflation is under control, the feds will immediately bring rates back down to keep the economy moving and avoid a complete recession. So, could we hit 6% by the end of summer? It definitely seems possible. But could we be back to 5% by Christmas? Also possible. In the meantime, let's talk effects. Early in the year, many buyers jumped into the market to beat these rate hikes. Now, although rates are going up, do you really think that buyers won't purchase a home? I sincerely don't agree with that statement. In my 20 years of real estate experience, I've never spoken to a buyer that decided not to buy a home because of interest rates. What it will do, however, is lower the purchase price for many low-end buyers. So rather than speak in hypotheticals, here's an example. As we learned in the previous monthly update episode, the median home price right now is $465,000 here in Vegas. Now at 4% interest, the principal and interest payment on a 30-year mortgage was $1,776. Raise that interest rate to 5%, and now that jumps to $1,997. Meaning, the average buyer out there is now paying a little over $200 per month for the same home at the same sales price as, say, in January. For the person buying a home with a $2,500 a month payment, $200 isn't enough to deter them from purchasing. However, especially in this market where home values are going up so quickly, many buyers max out their qualifying amount. Now, what I mean is this: regardless of what buyers can actually afford, most buyers tend to purchase whatever they can qualify for. In mortgage parlance, this is referred to as DTI, or debt to income ratio. For simplicity's sake, let's say it's about 50%, meaning 50% of what you bring home monthly is the maximum amount of debt obligation a lender will allow. So, working it backwards, the higher the interest rate, the higher the payment. Now, the higher the monthly payment, the lower the price of a home a buyer can qualify for. Now, with rates up to 6%, now that buyer is paying over $400 a month more than they would have been paying back in January. But to really see the impact, let's look at the purchase price difference. At 4% interest back in January, $1,776 a month got you a $465,000 home. But if rates hit 6% in, say, August, $1,776 a month will only qualify you for a $370,000 home. With a 2% rate increase, that buyer just lost $100,000 worth of purchasing power, real dollars. Combine that sad news with increasing home values, and now a buyer who once was looking at a nice median-priced home is now looking at a decent condo, all for the same monthly payment. So back to my original statement. I've never had a buyer not decide to buy because of interest rates. Now, what I have seen many times over the years are buyers that decide not to purchase simply because what they are pre-qualified for doesn't match the type of property they were hoping to get. Now, even though we've seen the real effect interest rates have on the market, it's important to take a step back. We tend to overreact and have a very short memory span. While 6% sounds insane, considering we were just at 2.65% not too long ago, that too was utterly insane. To drive this point home, on the screen now is a historical look at interest rates since 1975. While obviously it's difficult to imagine 16.5% interest back in like 1981, notice that during the boom of the early 2000s, interest rates hovered around 6%. Throughout the 90s, rates were between 7 and 10%. So while 5% seems high to us right now, historically this is insanely low. In fact, we never saw rates this low before the recession in 2009. But that leads me to the next subject. What's next? Well, we have two options, or perhaps we have a blend of two options. First, as the cost of owning a home goes up, the market will cool off and potentially values could decline. Or, while rates were actually higher during the housing boom in the early 2000s, we all tend to remember mortgages being cheap, right? Why? Now, if you remember, everyone took out interest-only loans on like 3-year or 5-year adjustable rate mortgages. These mortgages were cheap because they were terrible loans for consumers to begin with. Well, if you know me, you know that I always will bet on the side of greed. Human nature is greedy and foolish. Give a man a fishing rod and he'll learn how to feed himself. Give that man a grenade and he'll kill more fish than he can possibly eat. He'll destroy the ecosystem and wind up starving to death after a month. Well, banks are like those grenades. They'll feed our egos until we choke on them. So don't be surprised at all to see the return of adjustable rate mortgages this summer. Interest-only loans could come back in a big way. I mean, can't you see the pitch now? Hey, secure the house now before it goes up. Take the interest-only loan so it's affordable, but then call me back next year and I'll refi you into a 30-year fix when the rates come back down. Sadly, I wish I were joking here. Hey, the first iPhone was $500. Now they're up to like $1,500. Do you think Apple's losing sales? No, because now they'll lease you that phone for only $62 a month and nobody blinks. Ford F-150 trucks hit 100 grand? No problem. We'll finance you over 84 months. It's the American dream, right? Grab your piece of the pie, even if it's poisoned. You deserve it. In the end, the point I'm trying to make is that while this market is perplexing, and specifically here in Las Vegas, we have migration patterns that most cities just don't have, just because interest rates are going up, it doesn't necessarily mean that the market is going to crash or correct itself. What we learned from 2008 is that real estate markets can be volatile. They can change course rather quickly. But if you look closely enough, the signs are always there. The economic laws of supply and demand exist for a reason, but never underestimate the effects that manipulation have on markets as well. So moving forward, let's see if sales continue to slow down. Let's see if inventory hyperinflates. Then let's see if the banking industry responds with exotic loans again to keep those wheels turning. A natural slowdown could do the market some good, but financial manipulations could easily find us repeating history earlier than expected. Well, that's it for this month, everyone. Please let me know what you think by leaving comments and questions for me below. Please be sure to subscribe, and most of all, man, just have a wonderful spring, everyone. I'll see you next month.